is going out there. It's February 24th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down headlines and tell you what's really moving these markets. You know by now, since I pitch it all the time, that we have a Curzio Research YouTube page. So go there, subscribe it. We do all of our videos now, our interviews, everything. So if you are watching this through that, which a lot of you watch through iTunes, you can go there and watch Curzio Research and go to our YouTube page. But I have a Penn State shirt on, right? Penn State t-shirt. And my best friend, Zach, got that for me. I know him since I'm 3 years old, believe it or not. So he visited the campus because his daughter got accepted to the college. And, 95% chance she's going there. So he did a very, very good thing and bought me a Penn State t-shirt. And you could see it pretty good. I'll show you a couple different views here. If it's here, we got cameras all over here with our views and stuff like that. But two things. One is it was a big step for him because he's a huge Michigan fan. So we always talk, crap or whatever when they play each other. And this year, both teams were so freaking horrible. It was a joke, so it was kind of funny. But the second thing is, my buddy Zach does pretty well. He owns like all of Queens, New York, and he buys me a t-shirt. Come on, a t-shirt? I mean, I thought he sent me like a signed football from Saquon Barkley or something. But anyway, congratulations. I want to give his daughter a shout for getting to Penn State. And congratulations for buying me the shirt, even though he hates Penn State, which now, since his daughter goes there, he's going to have to become a fan so we can watch the games together. So, let's begin with this. In 1998, I was working for my dad. He has his own firm called FXC Investors Corp, where he was managing money at the time, and he also wrote a newsletter for over 25 years, right? I've said this numerous times. A lot of you know this. Now, my dad was the only person who called the 1987 market crash in writing. I mean, it's kind of like, once things happen, everybody says they call it. Kind of like the housing crisis. Like everybody, did you notice that everybody called it? Everybody called it. No, everybody called it. After the fact, everybody called it. Yeah, right. But I published this newsletter and posted it on Twitter at Frank Curzio. You could see it. And I'm also bringing it up right now because it's relevant to my story here. And you could see it. And this is his newsletter. And I have you can follow us on Twitter if you want. I post it on Twitter as well, again, at Frank Curzio. But this is his October 1987 update, which came out September 25th. And it's titled Crash. And it says, we're now in a bear market. Dow above 2,700. It's at over 21 times earnings. Sound familiar? That's kind of what we are right now. Approximately 200% over book value. Talks about massive loans outstanding from the so-called LDCs, which is less developed countries, exceeding $400 billion. Remember when $400 billion was like a big number? That's like nothing now, right? It's like chump change. Talks about the huge federal budget deficit, things that we're seeing today. And he said 3 crashes occurred. I'm bringing this up now to show you guys. So here's the crash call. And this is his newsletter. And he goes on to say 3 crashes occurred in October. That was 1929, 1978, 1979. So we're going into October. He says this month's crash could be worse than the prior 3 crashes combined. He said that less than 3 weeks before the market crashed. And he goes on and talks about it. And this is cool. Again, it's nice to see these old newsletters, right? Because there was no internet back then. He says, since 90% of our research is based on fundamental, not technical analysis, we would defer purchasing most stocks at this time. Since 1929, stocks have never been turbulently, fundamentally overvalued as now. And he goes on to say the entire free world's economic foundation is showing signs of cracking, an earthquake that may spread its fault from Los Angeles to Japan and Wall Street. He calls it the financial triangle. And then he has a little chart, which is really interesting, right? And he shows October 24th or October 29, 1929, how the market crashed 47%. October 29, this is to night 32, right? So 29 to 32, also the market crashed 89%. And then he has a time date, 10/1/87, remember, crashed like 3 weeks later, through and he's calling it for, the month through November that the market's going to crash. And he has question marks of how much is going to crash. So still one of the best newsletters. And of course I'm biased here. But really one of the best newsletters, one of the best calls I've ever seen, because so many people say, they saw this coming, they saw that coming and everything. But, reality, when you have it in writing and, it was a big deal, right? It was a really big deal. Because back then, Remember, no internet, no nothing. You had to go to the library to research reports. We had like Quotrons back then. That was the technology that they used to get a couple quotes. And there was only a handful, in CBC when that started, that investors followed. Right? It's not like it is today. Right? So it was like Mario Gabelli, Abby Cohen, Louis Navalier, Jim Cramer, and, my dad was one of them, about, 10, 12 people. But today we have literally hundreds of analysts on TV just, shouting to the rooftops, most of them, promoting whatever they own. And again, back then, it's not like today where we have, egotistical idiots who don't give a shit about the small investor calling for a crash every year since the credit crisis in order to get more Twitter followers and sell more books. And then you know what happens, right? When the market pulls back 10%, they take a victory lap, even though the market's up like 250% from when they first had that call, which is, that's changing of the times, right? Nobody cares. Sorry about that mini rant. But going through that 1987 crash, my dad was prepared. He was hedged, short the market. Probably his biggest score in his career, because during those times, everyone was super bullish. And you have all these people leaning to one side, right? Side of the pendulum, where you're able to get in at an incredible price when that happens, right? You're able to buy stuff when nobody wants it, whether you're shorting it or going long. Good example, think Michael Burry, Mark Baum, right? Those guys made a fortune off the credit crisis, in the housing bubble. They did their research. They were able to short housing, and actually, it was so big, they created their own products. I don't know if you know that. I think that's, if you read the book. They created their own products through some of these investment firms so they could leverage their position and short the housing bubble. And like Goldman Sachs always said, sure, you want to do this? No problem, right? So like housing never crashes and never ever crashes, but they did the homework and they knew. There was so much leverage in the market. But that's what happened when you make the most money, when you see a market or you're investing in a major event that nobody sees coming. Remember that point, I'm going to bring it back later. For example, you can make money on Tesla by buying it now, like Cathie Wood just did. She added to a position, and Tesla came back a little bit. It's down 20%, but, she's not going to make a killing on that $170 million. Now, with Tesla at this price, could double. I don't know. Tesla could triple and quadruple the way that stock trades. But you get my drift, where there's a pretty big difference where you're buying Tesla at $750, $800 compared to buying it at $40. And Cathie Wood's, ARK Investment, she was early to that investment. Barron, their fund, Barron's has been a huge supporter of that. Again, at 30s and 40s, amazing. But that's how you make the most money. Again, I'm going to bring back that point later on. But getting back to my dad. After the crash, he saw tons of people get wiped out. They were on margin. Old friends that lost contact with him suddenly were calling him, asking, what should we do? Because they got destroyed. They thought they were smarter than everybody. And living through that event, the emotions you see when something dramatic happens, it changes you forever. Think about it. Maybe you got into a car crash or a major skiing accident. I mean, next time you drive or ski, you're going to be super cautious because you're well aware of the consequences because you just lived through that, right? You lived through it personally. Now, fast forward to 1998. This is when I was working with my dad. This is the internet boom. Tech stocks were surging, and they were surging for a couple of years now. And I'm going to bring up a chart to show you this. Why I just shout numbers at you, but it's going to be very important. I promise you I'll make this interesting. So here's a NASDAQ chart going back to the 80s, but let's look at the 90s here. So when you look at the 90s, the NASDAQ from 1993, okay, say around 1,200, 1993, 1,200. Just put that 1,200 perspective. It's 13,000 today, pretty close to 13,000 today, right? Just put perspective. But it went from 1,200 to 3,000 by 1998. All right, so nice move here. 3,000, 1998, April 1998. That's 150% gain in 5 years, 30% annualized returns, which is incredible, right? Like over a 5-year period. And we didn't have a lot of exposure to technology. So for me, I'm like, hey, Dad, we need exposure to this, and just showing you this chart here where the NASDAQ was and how it surged and came back down. But when you see this event and you see what's going on, they've been taking off. They were absolutely taking off. So, and it's mostly technology, right? It's mostly the NASDAQ. And I'm looking at this going, hey, Dad, you know what? We really need to get into this. We have to get into this. And this internet thing is real. Let's get exposure to this sector as, we're seeing .com IPOs going up 100% in weeks. And nobody wants to hear about, hey, buy, hold, make 12% a year, which is an amazing return. Nobody wants to hear that, right? Just like they don't want to hear that in today's market. So we created a top 10 tech newsletter where I recommended 10 technology stocks. Well, I know my dad was just pretty much setting me up, right, to learn a valuable lesson. He's like, hey, you start it. See what happens. Now, a lot of people forget this, but from July to August of 98, the NASDAQ crashed. In 1998, it crashed. It fell more than 20%, 3,000 to below 2,400. And that 20% correction was like a month. It happened quick, and it turned out to be a head fake. So nobody really cares. So nobody talks about it. They just talk about this massive run-up. It was like, whoa, here it comes. This comes. And it didn't. It didn't really continue. It was a head fake. It only happened for a month. And I remember my dad saying, listen, be careful because this is not going to last forever. These returns have been doing this for decades. It's not going to last forever. So me at the time, being young, I'm like, you know what, Dad, you don't know what you're talking about. We need to buy more here on this pullback because I'm smarter than you. I know what I'm doing. Again, I'm smarter than my dad, being an analyst for a few years when he's been doing this for decades. Of course, that was my ego talking. From August 98, the NASDAQ started another major move higher. It surged to 3,500 by year end. That's the year end of 1998. Amazing gain. To 3,500 and then doubled again in 1999. And that was pretty much in 1999 through February 2000, which was a top. It went to 7,000. That's how high it ran. That's how extended it is. Lots of lessons to learn here. When you see bubbles usually go a lot further than people think, just like downturns. That pendulum usually swings well over before we see that adjustment. So a lot of people, a lot of good investors could be early to their calls. But 7,000 it went to. Of course, I'm sitting at the top of the world. I'm the genius. I'm amazing. Everyone was making money. And I'm young at the time. I'm supposed to feel that way. Just like young investors feel today. But it only lasted a little while. So NASDAQ peaked in March. I think it was 7,200. And then came the crash. Now, this crash wasn't like the recent ones we had from 2008 or last year, right? 2020, which some of you have lived through if you're a young investor. Because when you see those markets compared to, or those times compared to internet crash, when the market crashed after 2000, it was a 2.5-year crash where it fell tremendously. It felt like it was going down every single day. There was no, the Fed wasn't like, hey, this market's going down 25%, let's throw $1 trillion in. There was nothing of that. Like, no one ever thought of doing that back then. But it was long. It was painful. 2.5 years is a long time. I mean, nowadays with the internet and everything, TikTok, 30 seconds is a long time. I need it in 5 seconds, right? It's a different world. 2.5 years. The NASDAQ fell, eventually bottomed at 1,700. So the NASDAQ crashed. Keep in mind, this is a major index. We're not talking about a stock. This is a major index. Fell by 76%. Several of those top 10 technology stocks in my newsletter went under. Others went down 80, 90%. It was basically a complete wipeout. And for me, I had my tail between my legs. No idea what happened. I felt like a truck just ran over me. I'm like, what happened? I have no idea what happened. I lost my own money. And more importantly, my subscribers who followed me for that newsletter, I lost their money and I let them down. But there's several lessons to learn from this. And hopefully I could pound this into your brain. I'm going to try. It's probably not going to work, but I'm going to try. One is my dad was a pretty smart man. He knew I was going to fuck up. Sorry for cursing. But he let me make my own mistakes. He knew it was going to happen and said, the only way you're going to learn is if this happens to you personally. And that lesson, pretty much one of the most valuable in terms of my investing career. Because I learned about risk and how you have to control risk, why that's important. And of course, if you manage other people's money and leverage 30 to 1, you make as much money as you can, right? That's what so many hedge funds do, right? They leverage other people's money. But I'm talking about you, average investors. I mean, you have to limit your risk because once you lose that money, it's gone. You can't do it. You're gone. And the timing's terrible because the market's crashing and you want to have dry powder. It's the best time to buy stocks. But for me, it was a valuable lesson because I lived through it. My emotions were involved. I lost my own money. I let my customers down. And those emotions that you experience, I can't explain it. But it crushes you. Now, the past few years, we've seen the market surge. Of course, that was till March, right, when the pandemic hit, COVID. And then in recent months, a lot of young investors started getting into the markets. They downloaded Robinhood, the best app ever, easy to use, free trading. They changed the entire industry because everyone wanted free trading after that. They joined blogs like Reddit, Wall Street Bets, where everyone's pumping ideas. Good for them. Many of those names they're pumping have gone up 2x, 3x, 5x, up tremendously. It's all fun. This trend sounds kind of familiar, right? A little bit familiar to the tech bubble. Because then we saw GameStop, AMC, United Airlines, heavily shorted names. We saw these names surge. I think GameStop hit 500 for a brief period, 500. And it was trading in single digits like 4 or 5 months before that. And it went up so high, not because GameStop's a great company, but because it came one of the greatest short squeezes of all time. A stock where the percent that was short of the float was 140%. You don't have 100% of float, 140%. That's how leveraged they were. And almost put Melvin Capital out of business. Again, a hedge fund leveraging other people's money. And they got caught out there. Now to get bailed out for like $2.5 billion. It's always nice being a hedge fund. Yeah, some of these guys have some of their money in it, but all this money is someone else's. It's a lot easier to do that. Because if you're right, you're going to make a fortune. If not, hey, you're going to be able to start another fund next year and everyone's going to forget. That's Wall Street. It sucks. That's the way it is. But it's the truth. But over the past few weeks, what have we seen? GameStop go from $350 to under $50. AMC fall. Tesla fell by 20%. Tilray down 50% from its highs. And I know a lot of investors, even some emails that I've got, bought these names near their highs. That's the FOMO, fear of missing out. The problem is you fear missing out. The last people that get in get destroyed. And unfortunately, that's usually a lot of people. They just programmed to think that these things are going to go up forever. They talk to their friends and they're like, oh, I made so much money on this. I made so much money on that. I made so much money on this. And they're like, damn, I got to get in this, man. These guys are making so much money. And they wind up getting rumped and they get crushed. They get destroyed. So a lot of these investors bought names near their highs. Again, thinking they'll go up forever. And you might be right. Like when it comes to Tesla or some other electric vehicle stocks or, the streaming giants, Netflix, they continue to go higher and higher. But if you're looking at GameStop particularly, I hear a lot of young investors, and this is people who follow me on I have Frank Curzio Twitter or YouTube, and I see them on social media networks. I'm holding GameStop forever. I'm holding it forever. It's like a symbol that we could be just as powerful as Wall Street, even though they can't. And I know Melvin Capital is a good example, but you know how many hedge funds, which no one's talking about, shorted the shit out of GameStop at 300, 200, and 100 and made a fortune? A lot. You don't hear that story. It's not interesting. So when you just hear one fund, which $12.5 billion fund, Melvin Capital, gets nailed, that's really a very, very tiny amount considering it's $1 trillion industry. But yeah, it's a great story. Hey, we beat Wall Street. The young guys beat Wall Street. It's fantastic. But you have to be careful. Because when it comes to GameStop and saying you're going to hold it forever, and I don't care if I'm down, it's a terrible mindset considering the asset you own, GameStop, is basically worthless. Since its business model of selling video games through big box outlets is obsolete. Well, it's becoming obsolete. Many games can be downloaded straight from consoles. And for those who still feel the need to go into a store and buy a game, you have Walmart, Target in every single town. So unless they change their business model, get into whatever it is, that's different. But the current business model right now, the company's basically worthless. So you're holding on to a worthless asset just to prove a point. And that point's going to be is that you're going to get your ass handed to you from Wall Street and lose a lot of money. Because your ego's involved. Now, that's not a bad thing, because as a young investor, you have plenty of working power. You're going to be generating a lot more money. You're going to be smarter. And as that young investor, like for me, the only way you learn about that kind of risk is by going through those tough times yourself. You can't read about it in books, how the market wiped out everyone in past crashes and don't be leveraged and how you need to be. You could read that, but it's not the same thing. I mean, it's like explain to people how fucked up Vietnam was because you read a few books about it. But imagine talking to a veteran who actually fought in that war, took on fire, watched members of platoon getting killed. I mean, it's a totally different experience than just reading a book. So as much as I say I want to teach young investors, I want to help you guys to get better and better and better, when we have a market like today, outside of last week, when stocks are surging, going through the roof, everyone's making money, it's real difficult. It's not easy because you haven't lived through a crash. You haven't lost all your money to where you can't sleep or what the hell am I going to do? Those emotions are so important. And just to be clear, I'm not predicting a crash here. We have super low interest rates, probably forever. They say through 2022. It's going to be a lot longer than that. Long-term rates are going higher, but the Fed, if they go meaningfully higher, they're going to implement yield curve control. They have to. We have too much debt. And this isn't just, I called this for a while. I think it's going to happen. But we have, some of the best bond investors in the world who said, yes, they could implement yield curve control. It's probably going to happen. We have trillions in stimulus still coming into the market. Even past stimulus programs, we still have money that hasn't come into the market yet. Which means what? It's going to cause assets to continue to inflate, like housing. I don't know if you saw Lowe's comp numbers, up 28% year over year. Comp numbers. Are you kidding me? Compared to last 28% year over year. Holy cow. It's insane. I mean, that's, you're taking out like the 9-month period really from the pandemic. 28%, right? This comparable call to the last comparable call a year ago. Unbelievable. Did you see Toll Brothers results yesterday? Blew them out. You're going to see art, collectibles, equities continue to rise, but not to the point where every equity you should just buy at any price. I mean, Lucid Motors in that deal, it was $20 billion valuation, pro forma results, $20 billion valuation for a company that doesn't even have an electric car in the market yet. Are you kidding me? That's awesome. $20 billion for a company where we generate more revenue at Curzio Research than these guys. $20 billion. It's just, start or just make announcements, right? Now a publicly traded company or our CEO token, just say, hey, we're going to build spaceships that run on batteries that have extra green features in them to hit every single market. And then we're going to have cameras all over with cloud capabilities and AI. And you know what? Our CEO token will be worth $10 billion. That's the way the market is. It's crazy. Obviously, I'm exaggerating a little bit here, but not too much. You're seeing the valuations in this. But we saw Lucid Motors get hit. We saw a lot of these names get hit. And we're going to continue to see pullbacks among certain sectors and stocks that have run up too fast. So while you want to remain bullish or fully invested, since, again, we have very favorable market conditions, I'm going to be here for a while. But if you want to remain bullish, you need to learn how to protect yourself, even if it's just a little bit. I know it's hard. It's pedal to the metal. I want all or nothing. You want to buy the stock at the absolute low and sell at the absolute high, which absolutely never happens. But that's what you want. Most people buy it at the highest price and sell at the lowest price. That's the way our brains are programmed. But the greed factor kicks in and you think you're a genius and you want more. But you need to protect yourself. Because like my dad, after the markets crashed and the dust settled, he was one of the few that was still standing. Built his company up, it prospered. Business started to surge because he was prepared. And the biggest lesson here, guys, the biggest lesson, he was sitting on a huge cash pile. Market crashed. What does that mean? You could buy assets that were dirt cheap. That's what the greatest investors do. They did it in 2001 after the tech crash. They did it in 2009 with hedge funds and private equity funds. We were able to buy real estate assets, these structured investments from European banks, even some U.S. banks, for pennies on the dollar. Pennies on the dollar. Look at Fannie and Freddie getting all that real estate. They're making so much money, Fannie and Freddie, they didn't know what to do with them. They thought, we're going to dissolve these things. Conservatorship, they're done. They're making billions in profits. Billions, billions, billions. Well, home loans and everything. But during that time, the governments go overboard, and they said they got to unload risk, these banks, and they force them to sell these assets, and the people with money get to buy them for pennies on a dollar. That's what the best investors do. Einhorn, Ackman, Lowe, Icahn, Buffett. Numerous examples of these guys doing it. They always get super aggressive during downturns since they have money to buy assets that become incredibly discounted. That's why it's very, very important to hedge yourself. Maybe you hedge yourself 2%, 3%, or 5% of your portfolio. What does that mean? When the market crashes, this 3 to 5% that you're hedging could become 25% to 30% of your portfolio, since the gains could easily be 3x to 10x if you hedge the right way. And if you're wrong on your hedge, you lose 2 to 3% of your portfolio. Big deal. You know why? Because all your long positions are surging. You're going to be up 10, 15% in the market, especially in today's markets over the past couple of years. But you're hedging yourself just in case, because, again, when the market does come down and you're seeing some technology companies get hit, those who are left standing, those who have, look at, you could say Cathie Wood. Tesla came down. Hey, we have money. We have cash on the sidelines, and they added to their position. I don't know if that's more about ego. I don't know if I'd buy that big of a position, which may not be that big for a company, ARK Investments. But still, you're buying it after it gets crushed. You could buy Bitcoin when it goes to maybe 40, 35. Who knows where it's going to go? But I know the underlying trends look extremely favorable. I'll talk about that later on. But that's what you want to do. I mean, look back at housing. Imagine if you purchased a home in 2010, 11, 12, after the market crashed. Imagine you purchased the market, some of these stocks you went long on, some of these great companies in April of last year. I mean, you're up probably 3x, 4x, 5x. Instead, a lot of people got murdered, and they're sitting there going, wow, I have no money left, when it's one of the greatest buying opportunities that they'll find. And when it comes to hedging, it's not easy. So I'm glad we have one of the best analysts, Curzio Research, that can walk you through this and teach you exactly how to hedge. And that's Genia Turanova, who runs a Moneyflow trader newsletter, Curzio Research. Proud of this product. I love this product. It focuses on buying long-dated puts, which is very simple to do, and helps hedge your portfolio. So she also runs our unlimited income product, which is not your typical income newsletter, because it focuses not just on the highest yielding stocks, but companies that are growing first is like the key. And then you look to see if they're paying a nice yield, because it makes no sense to buy a company that's yielding 6% if it's not growing and the stock falls 20% a year. Again, it makes that dividend kind of meaningless, right? And in that newsletter, just 8 positions, the last 8 positions are all in the green. She's doing very, very well. So it's going to be a great interview. Genia is super smart. Definitely listen up. It's been a great addition to my team. And let's get to that interview right now. Genia Turanova, thanks so much for coming on Wall Street Unplugged again.
Oh, thank you very much. I'm so happy to be talking to you. Today is a fun day in the market.
I know, right? We're seeing the market really come down, which is, we'll get to your Moneyflow trader portfolio, which is, used as a hedge. But of course, the market's been surging right now. But now we're going to see a lot of demand for it, obviously. But I want to talk first, because you have an economics background, and what's going on with the stock market, because we're seeing things, and it's hard to explain to people, right, for the first time, that I don't know if I could teach a young investor anything when they're buying stocks with no earnings, or SPACs that are, coming out at taking over companies at $20 billion valuations with no products on the market yet. It's tough to tell them to take it easy when a lot of these things are going up 3, 4, 5x. But as we're seeing right now in the market, we're seeing a major correction. What's your view in the markets and even the economy? And is it a sector rotation thing, or are you nervous right now for the whole market to come down? But let me hear your thoughts, because I love when you talk about, the macro point of view, and I know that leads to a lot of ideas for everybody.
From the macro point of view, the market doesn't look too scary, only because of the interest rates that are artificially low, and because of the enormous amount of money that's been released into the economy. There's 2 sides to this money equation. There's a lot of extra money that was printed, quote unquote. Mm-hmm. The Fed's balance sheet has been, it's almost doubled over the past year. And the last time it did double in a short period of time was during the Great Recession. So it is a big deal for the market, for the market support. And it's also a very different from anything we really have experience with, because of the low interest rate. Money is free. Rate is low, money is free, do whatever you want. It's not going to, last forever, but low rates does support the economy, does support the market, and it gives you the feeling that you'll be fine for a long time, which is not likely the case. At some point, it will balance out a little bit, like it did in the past 3 months too. I think it was a little bit of a rotation, with energy surging 30% or more, and the utilities declining 5%, I think, over the past 3 months.
Mm-hmm.
And the market was up 9%, with energy, as I said, up 34%, and the financials up 20%. So it's not like you buy just anything and will go up. Even over the past 3 months, you buy something safe and it would be down. That speaks volumes to what you just said about the young investor. Just throw the money at the market and it will do well for you. I really don't think it's the case long term.
Yeah, so let's talk about that, because I guess the big question, right? Everyone wants to know when will it happen? Because we could really say with the last 20% move higher before the recent decline this week that the same factors were in place: low interest rates, free money, and eventually, when does valuation matter? And that's a tough question. I don't know how to answer it, but when does valuation matter? Because it could be the same argument. I'm always worried about when people are buying the market for the same exact reason they bought it 20% ago, or buying a stock for the same reason, because it seems like a lot of that is factored in. But we're seeing long-term rates go higher. Is that something? I mean, we could always have yield curve control come in from the Fed, which they did in the past. But what could be the catalyst that really pushes us down? And maybe that's what we're seeing right now. Although we're down a little bit compared to how much we've come up. But I guess everybody wants to know, including me, and it's hard to determine it, is when's that time frame? When are valuations really going to matter again?
I can't tell you that. I cannot give you the sure answer. The only sure answer is that this time is not different. It may be slightly different. The environment has changed, so the normalized valuation may be a little bit higher than we used to. So in a sense, it's different, but it's not different in the sense that whether the market valuation matters. Because if equities represent ownership, you don't want to buy anything that's priced 100, 200, 300 annual future income. Do you want to own any asset that will potentially return something to you in a normal way in 300 years? Probably not. So eventually this will all balance out a little bit. Maybe with free money, your timeline for how much you're giving to give your equity to pay you back, your timeline will expand. Mm-hmm. But again, the question is by how much?
Yeah, and to be fair, I mean, it just is a tough question, because I'm trying to figure it out too, where, you think you're smart taking profits and you'll see a stock double from here when it was really expensive. But now we're seeing, you talk about where it's not all stocks, right? So we've seen, the ESG stocks, environment, batteries related stocks in the major growth trends, especially in the SPAC area. These things have taken off tremendously, but we are seeing a rotation. We're actually seeing even in the market today where the financials are coming back. The cyclicals have done well this week, right? These are plays on the economy where, you just see the NASDAQ get crushed in a lot of growth stocks, and those are the fan favorites. Tesla down more than 20%. And that's a lot of people talking, but there
in 2 days.
Yeah, I know, right? And there are things that are working here. So talk about the rotation here and maybe cyclicals, but it's not so much where I think so many people, right, they look at the market as a whole and say, oh, I got to get out. But a lot of individual names are actually performing pretty well over the past 5 days if you're in the right areas, right?
Absolutely. What I think is happening, and it might be just the beginning of the process, is the buy the rumor, sell the news kind of environment. So we have been buying the rumor for the past 9 months. The reopening, it's not really a rumor, it's happening. We don't know the exact timeline is not clear, but we know we're reopening. We know the economy is coming back. We know that it's coming back strong. We know for sure that we're going to beat it. So that's not a rumor per se, but it's a rumor in the sense that you want to be ahead of the market, ahead of the trend, and everything that was a reopened trade has been bought. Now we're seeing like selling the news kind of environment when we do understand that the vaccine is working. We do understand that it's may not be as fast as we would like it to be, but in 2021, we will probably be significantly over this by the end of the year. Mm-hmm. So again, another 10 months, give or take. So again, it's selling the news kind of environment. You don't want to guess when the buy the rumor, sell the news will change. So you want to have a little bit of both. But I think that's what's happening.
Yeah, no, it definitely makes sense to me. And I want to turn everyone's attention over to Moneyflow Trader, because this is one of my favorite newsletters at all, Curzio Research. And when you took this over, I mean, the timing was really, really good because we saw the market absolutely crash. And this is just a portion of this, but most of it is you're buying puts for protection. And of course, you're buying puts, right? You're betting a stock. You're not going short, so you can only lose the amount of money you put up. But with a crazy market like this and how nuts it is, like when you saw the market really come down tremendously, March, April, starting in February, you saw positions go up 100, 200, even 500%. But now it's a bull market in every single thing in the world before this week, right? So, of course, that portfolio is going to take it. But explain to people, and I try to do it, but I want to hear it from you as well, is what this portfolio is meant to do. Because when I look at it from a hedge point of view, it's so important in this market. I understand that, especially now this week, people are like, wow. But explain that part of the newsletter of, using it as a hedge, which is something I do for my own portfolio.
Right. So I do believe in the market. I do believe in the market wisdom. And I do believe that over time, the markets do move higher. And that's really the basic of making money in the market, not being persuaded that, now it's going to be a 10-year bear market. You get out, sit in cash, and you'll be fine. I think you should be invested. And to be invested in a difficult environment like this, when everything can turn on a dime, it depends on the Fed support. Fed has been pledging the support, but again, it's already in the news. It's already priced in. In a crazy environment like this, when any kind of recovery is already priced in, anything can happen. Not to mention, like, given something like last year, which almost exactly a year ago we had a market high, and then we experienced the fastest bear market on record. You can't prepare during the bear market, especially as fast as the furious has been coming on lately. You can't prepare during that decline. Volatility goes up, everything is super expensive, and you can't really buy a hedge unless you did it ahead of time or benefit from the hedge. You can buy it, but you're not likely to make money on it because you're buying it at a very high price, as we did with a couple of hedges that didn't do so well because we're trying to hedge extra during that decline. And again, just an example of you need to be prepared. And it's just everywhere else, you must be diversified. So you spread your bets across few positions. Some have high chances of success in the recovery. Some have much better chances of success if we're stuck in the mire of not growing economy. So you have to have a few hedges across the universe of potential reason for the market decline. And of course, you want to own a hedge on super crazy valued stocks. Not every single one of them, and not every single of your hedges must be on the super valued stocks, because again, as we just discussed, the high volatility and high valuations may continue for a long time. But again, the more you hedged, the better you can be invested elsewhere. So if you hedged, you're actually benefiting from this market upside without, well, maybe not without the worry in the world, but with better confidence.
Yeah, and I came to you a few months ago, maybe like 5 months ago, and for me, for Curzio Research Advisory members, I wanted to provide one of these hedges. So what I did is we bought a put on Disney. Dead wrong, the stock went up tremendously. And what I instructed everybody to do, just to bring in a real example here, and I even consulted you on the trade as well before I actually did it, because you're the expert in this field, I said, look, this is a trade where you put 2%, 3% of your portfolio in, and this is the most leveraged company to COVID, right? So if everything starts reopening, this stock is going to take off. And if not, this stock's going to get nailed. So what happens is the recoveries happened, the stock took off, and that's okay. We lost a full amount of that position, right? But the rest of our portfolio is surging because we're well positioned for everything else. Now, if the market came down, that small 3% position on that option could be worth 10, 15% of your portfolio if it comes down. And that's how you hedge with a small amount of money. And I know that process is difficult for people, and people want, full upside. And even for Moneyflow Trader, right, Genia, that's not the only thing you provide Moneyflow Trader. Well, you have long positions now too, and structuring the portfolio the right way, which is a great job. But that's the most important point to me, right? Is just taking a small amount of money, being able to hedge. And if you're right, it's going to amount to a massive gain. And if you're wrong, you should make sure everything else in your portfolio is going to benefit. This way, that I'm willing to lose 2-3% of my portfolio because everything else is up 15% plus. And even more than that during this bull market. I mean, that's the way I kind of look at it in a real life example.
Absolutely. And that's a good point. Ideally, you don't want all your trades point in the same direction. That's when you can lose a lot.
Mm-hmm. Yeah. No, absolutely. And for this portfolio, I think right now it's funny because I can see the market's been up and, you could see that reflected in the performance, which is fun. Now the market's down, and everyone's like, okay, what do we need to do? Because when you see some of these things, some of these names fall 20%, like in a couple of days, these things could go up, 5x, 10x right away. And that's a great hedge. It makes you feel good because now you're not worried about looking at every stock every day and you're getting crushed, where if the market comes down, you're protected. And Ginny, you've been doing this for a very long time. You know a lot of big events. This is how the best investors, even the hedge funds, this is what they do, right, with their portfolios. And it's, it helps you last in the market and, not get crushed during times when things are bad. And also, when times are good, it's perfectly fine. But getting crushed, you lose everything. You can really get hurt. But this is like a strategy used by I know you is some of the best market professionals out there.
Generally speaking, that's what hedging is. You're willing to lose 100% on your hedge if everything else does well, and that's what we're trying to do. And yes, absolutely, that's what the professionals do, and this is what I, when I was in business school 20 years ago, I strived to understand. I was like, and then they dawned on me: you stay invested. That's what lets you. That's what hedging does.
No, that's great. That's great. I'm just showing a picture over here, Moneyflow Trader from a Curzio Research site. If you want to learn more, you can go there. But let's change tunes because now Moneyflow Trader is coming into focus with the market coming down. But I'm also going to show this because you are also editor of Unlimited Income, which is a front-end newsletter. So it's a low-price newsletter here. Unlimited Income. Tell us a little bit about that product. It's something that I really love because you take a different strategy towards income that, I'm very in favor of, where sometimes people will just look at the yield and look at MLP or REIT and it's paying 6%, 7%, 8%, and they don't realize that can't be sustained, especially if the underlying security, the underlying company is not a good company or maybe not growing. That stock could fall 20%, making that 8% yield absolutely meaningless. You take a really cool approach to this, and even the last, I think it's 8 or 9 picks that you've made in this portfolio, all in the green, doing very, very well. And again, this seems like this is an area that's going to see more inflows into it, especially in certain companies. But talk about your methodology behind this. This way we could, bring everybody in here.
Again, we did talk about it, and I love that we share the same approach. That if you want income, you must have growth. What I mean by this is that you can pick the best of this market. Stocks that can grow profits, and by extension, they grow dividends over time. And this way you don't lose your principal. Well, maybe again, that's why you diversified. You can promise that you cannot lose your principal on any of the stocks. But again, you stay diversified among the best of the dividend growth stocks. And this way you can almost guarantee that your income will go up over time. Your principal will be at the very minimum safe, or in our situation that we did over the past 6 or 7 months, your principal will go up, giving you again some cushion in case something goes wrong with the market. If you select good stocks, the income will be there, and the principal will maybe give in a little bit, giving you again more opportunities to buy because of your stock selection. Is all pointing to safer stocks that can grow dividends because they do have sustainable business with underlying growth. That's the only way you can beat inflation, which we all know is coming, and generate some safe income in this market.
So, a good example now, because we're seeing yields start to rise, right? We had a bunch of, hundreds of billions, I believe, in negative yielding bonds, right? And so, but interest rates are rising on the long term right now. So how do you position yourself? Because you see that, which, again, higher interest rates usually results in taking risk off the table, which what we're seeing right now. I don't know if that's the cause of the market pulling back while interest rates go higher. But do you look at it as if interest rates going high, you expect inflation? I mean, that seems like a great trade for bank stocks, which pay very high yields and are still considered cheap. And JP Morgan, I think it's at a new high, but a lot of these names aren't. I mean, is that a way you will look at it as well in a higher interest rate environment? You find it easier, or is it just, reallocating or finding new ideas? But does that change your philosophy at all with interest rates rising?
It does change it a little bit, but not that as much as the change the entire strategy. It would help me to pick my next stock and then the stock after next, because the market is changing. You must change. And again, you go back at your portfolio, if you review it and see which of your plays will work out long term, regardless of interest rates, and which are really susceptible to higher rates. I don't think too many of my positions are susceptible to higher rates, but of course they're not immune. We have utilities that gave in a little bit together with the entire utility sector. We had a few REITs that didn't do as well as the rest of the market, but the rest of our portfolio surged, had the financial technology, actually a few technology stocks. I have an industrial stock that has done well, and I expect it to do even better in the coming year. So overall, it's all about the balance, and it's all about being nimble and knowing where you are and anticipating some changes, and maybe playing back a little bit of your ideas and even sell a few that are not going to work out. But altogether, if a company is stable, if its profits are growing, if it's in command of its own destiny, whether you call it franchise or just a strong growing company, that's what you want to own.
No, that makes a lot of sense. And I guess let's get to the fun part, right? Which is, people always love ideas. Is there any ideas you could share, maybe even, hedging wise or for unlimited income? Because again, everybody always loves ideas. And of course, you're not going to give away anything that people are paying for, but you also have, lots of ideas to always share, which, we talk about. And just on a side note, Jenny, I'm going to share the secret is, we go back and forth and you ask for research reports on different companies. And every time you do that, when you ask for research reports, I'll send them to you. And there's if it's 15 different companies you give me, there's probably 7 or 8 that I'm totally interested in. And then some of them I never heard of. And I was like, wait a minute. And it hits my radar because it's funny the areas that you look at by asking me that and say, hey, do you see research reports on this from sell side analysts? But I love that part because it allows me to see, what you're thinking, but it gives me ideas as well. But let's get to the idea part. This way we could share that with everybody. If you have anything out there you want to share.
Well, sharing is a great thing, as you just said. So I think that one of my long-term favorites is something that will continue paying your account in nominal terms and in the potential price appreciation for a long, long time. It's a utility. So again, don't think that it's not going to do well in a rising interest rate market, because it's a utility that's leveraged to one of the main growth trends over this coming year and probably decade. It's a clean energy utility. It does both. It provides you, Frank, and the rest of your state with the electricity in its regulated part. And it also owns a lot of clean assets all over the country. Yields 2%, nothing's wrong with that, and can potentially go much higher than it is right now. NextEra Energy is my first pick. That's the name of the utility, and it's actually, in fact, it is the largest utility in the country. So there's nothing too exotic about it. Probably you, when you saw me asking you for a report, you knew what I was going for this particular stock.
It's funny. So next, you did a great job of masking that to the last second, right? But NextEra Energy, you got everybody excited for utility, but NEE is a symbol, and it's a $160 billion market cap, right? I didn't even know it was that big until you said it's one of the largest ones, or is the largest one. And yeah, I didn't even know they were that big. That's a monster company, but yeah, that's awesome. Thank you for sharing. And what about like hedging wise? I mean, you have anything there that people could say, hey, you know what, we'll buy, and it doesn't have to mean that you have to buy puts or anything, but maybe it's something that, you're looking to buy that might perform while the market doesn't do so well.
I think one of my better ideas, I guess that's a better way of saying it, is silver. I think silver is a little bit of everything. It's a precious metal. This is why it will probably continue benefiting from the money printing. It's an industrial metal. This is why it will continue benefiting from the recovery trade, from reflation trade. And it is also a clean energy metal, useful in solar. So it's three-way play. It's not as exciting probably as is the Bitcoin or other cyber currencies, but it should do well as a hedge, and it should do well as a recovery play. Silver is a little bit weird because of its in the middle kind of status. It's a precious metal and it's also an industrial metal, but all said, it outperformed the market by a wide margin last year. I think year over year, it's up about 50% or so. I'll take that.
No, that's definitely cool. And I know you've been early to silver, and you're saying, well, not that exciting, but I think the Reddit crowd might think differently, right? Because all this silver that they bought and everything, I used to think silver wasn't exciting either, but apparently it is to the young investors. And these people, some of them are holding long term. It's just that was funny you said that, because usually it is kind of gold and silver and boring and hold, but to see young investors saying, hey, silver, and again, it is linked to two different things that are really cool right now, right? So, and just the trends in the industrial metal part, but also just like, usually a safe haven and stuff. But all right, Genia. So listen, we covered a lot today. We covered economics in both of your newsletters. I just want to say that thank you so much. I love having you, work for us. We get great emails from you all the time. You're someone who has a ton of credibility, and I've seen it just where, I've been in this industry for 25 years, and you see a lot of people where they have losers and they don't mention them. You'll talk more about your losers and your winners and say exactly what you're going to do. And I think from a subscriber's point of view, they all know sometimes we're going to get things wrong, and that's what they want. They want to know someone's, has their back and they're in their corner. And just the emails that we're getting and testimonials, can attest to that. So I just want to say thank you so much for coming on and giving your analysis. And Moneyflow Trader and Unlimited Income Guys, you can go on our website if you want any more information. But thanks so much, Genia, for coming on. I really appreciate it.
Anytime. Thank you.
All right, guys. Great stuff from Genia. And look, Moneyflow Trader, if you subscribe to that, you're going to see some of the positions down because it's been a super bull market. You know what? And that's okay, because it's used as a hedge, 3-4% of your portfolio, where a lot of long positions, especially if you have a subscription to my products, you should be doing very well. You should be up a lot. We've had a great run. Yes, it's a bull market, but we've had a lot of great gains across all portfolios, and that's fine. I can tell you, when the market fell, in late February into March, COVID, several of the puts surged 100%, 300%, 500%. We got emails from subscribers going, holy shit, the market's crashing and I'm making money. And it was awesome. It was great. I love this product. I created it because it helps average investors invest like the pros. We should always be hedged, right? You want to maximize those gains while taking on, little risk as possible. That's the goal. And if the goal is to maximize gains and you don't care about risk, it's different, but you have to risk losing your whole investment. You don't want to do that. Just explain the best time to invest is when things come down. A good example of that is Tesla. 20% decline. Kathy Wood, ARK Investments, used that to invest was $170 million. This MicroStrategy, see that? Like Bitcoin play. It's down tremendously. And Bitcoin was down, 57,000 to 45,000. Now it's around 50,000 again. It's not down too much. Okay, it surged, but MicroStrategy stock went to like 1,300. It's down 40%. So by hedging yourself, by making sure you have money when things don't go in your favor, or if the market comes down, and the market will come down, guys. It will. It's a when, not if. It will. Trust me. It will. This is the markets. It's never this easy to make that much money. But when it does and you're protected, you're going to have money on the sidelines to invest in a lot of assets that are discounted. You might be able to get them for pennies on a dollar. Okay, that's what the great investors do. Now, we're getting lots of requests for Moneyflow Trader. And for me, I only push our newsletters. Again, Curzio Research, we sell newsletters. We're a business, right? That's how we make money. And we provide amazing value for that. We do our best and have videos with our newsletters and everything. And my job is to not sell the product when things are red hot and everything's great, right? Because a lot of people do that and then you wind up getting wrecked. I like to sell our products or push products when the timing is right. And we did a great job of that. Curzio Venture Opportunities, small caps took off. I told you they're going to take off. They did. They surged. And we did fantastic. Got in so many great names. And then crypto 4 or 5 months ago. Hopefully, some of those gains are just insane. I know some of those positions came down the past week, but we were up over 10x on 3 positions. And I think 10 of 14 were up between 300 and 700% or something. It was insane. That's my job, right? That's what I want to do. I want to show you profits because if I do, you're going to subscribe to more products and you're going to be part of our brand for the next 20, 30 years. That's the point. Moneyflow Trader, now's the time. And to help you guys out, you go to our website. There's going to be a banner there. It's not there now. So I can tell my team to do that. And I'll put a 50% discount on it for anyone who wants to subscribe. You're going to be in good hands with Genia. She's an awesome analyst. But what I'm seeing right now in the market with so many of these technology stocks, these high flyers are selling off tremendously. It gives you an opportunity to really, really make a lot of money and also hedge yourself as the market comes down. It's buying puts, long-dated puts. That's not the only thing. She also buys calls in it and option strategies. Very, very simple. She goes through it very easily. You could do it from your E-Trade account or whatever. But if you want to take advantage of that, I'll have it up probably for the next 5-10 days or so. And it's a 50% discount, Moneyflow Trader. The banner is on our site, CurzioResearch.com. It's going to be up there. It's the only place you're going to see the discount if you want it. If you want to subscribe, fine. If not, no worries. But I would do it over the next 10 days because I'll offer you a 50% discount because I really want people to learn how to hedge, especially in this market because it is getting dangerous out there. Now, so much going on. You guys know the format by now. I'm going to bring in my buddy, Daniel Creech, Senior Research Analyst, Curzio Research, whose birthday was yesterday. Happy birthday, Daniel.
Hey, thank you. Yeah. Another trip around the sun. That's exciting. Halfway to 70. It's good stuff.
So we had a subscriber write in and said, and this is on Twitter, Jake, who started watching a video stream version of the podcast and I was about to spit out my drink for the first time I saw Daniel and he wasn't a cowboy.
Well, with all those shooting stories and, being from the Midwest and all that, what's funny is that I lived in Montana for several years, and one of my good friends out there is an actual cowboy. In fact, when I was on the podcast 2 years ago when I was in Vegas, I was there for the National Final Rodeo. So yeah, I know him, but no, that's funny. No, I am not, I'm not the redneck cowboy that I come across as, that I am at heart anyway.
No, that was funny. I love that. I love just the comments we get. Sometimes they're fun. We read them if they're negative, just to have fun with it, but it's really cool. But the bottom line is, guys, we're here working hard, really trying to help you guys out. And there's a lot of things going on in the market. And I guess, Daniel, let's start with Bitcoin. We're seeing massive volatility. We saw the bears take a victory lap, even though they were bearish since like 8,000, and it went to 57,000. That's okay. That's a different story. But what we recently saw, and this is yesterday, Square said, when they reported their core, they bought another $170 million worth of Bitcoin. You've written about this with BlackRock, $9 billion in assets under management. They said they're looking into investing in Bitcoin. Guys, if they invest
they're dabbling
1%,
in it. They're dabbling in it. How funny is that?
Dabbling to them, 1% is $90 billion. That's a dabble for them. Right?
Yeah.
Maybe they go half, 45 billion. But that would be, 45 billion is what, about 5% of Bitcoin's market cap right now? I gotta look at the price. It is 49,700. Hold on, I can show them this view where I have the TV. I'm just checking out, doing this live as seeing as everything's going on. But what's the story with Bitcoin? It seems like I think it's very, very bullish that it came down, Daniel, and came down hard, and you saw buyers come in immediately. But when I hear guys like BlackRock, when I hear some of the biggest hedge fund managers, Ray Dalio, talk about it. I mean, these guys are no joke. These aren't like, the Melvin Capitals with 12 billion. These guys got hundreds of billions. I mean, trillions. Fidelity as well, trillions into this. I mean, what are your thoughts on it?
I just, it's scary to get so bullish. I was welcoming a good pullback. When anybody's texting you or calling you when it drops 10 or 15% or more, that's good. It needs to get people's attention. But the paradigm shift here that's going on. Did you see the interview yesterday on CNBC? What's the MicroStrategy CEO name?
Saylor, right?
Saylor.
Yep.
He, it went across the wire today. They bought another $1 billion or so. We talked about that. They keep buying, like you said, buyers are stepping in. But he made a great argument from his perspective on how people are not going to be trading this. People are looking for value. People are worried about the coming inflation and the monetary policies continuing for years and years and years. Maybe we'll get to that in a minute with Powell and Treasury Secretary Yellen up in front and doing some interviews and Q&A. But he was talking about how, the paradigm shift is if the price drops, these guys are buying more. They're not going to sell this. MicroStrategy isn't in this to make 50% or 100% on their return. Mm-hmm. Square's not in this. These guys are believers. So it seems too easy, but now that institutions are getting involved, I don't know how it doesn't crack six figures sooner than later. And, it's not silly to say this year.
There is.
Oh, gosh, I'm one of those guys. I'm getting into price targets.
but it's hard to argue against it when you see so many it just makes a better alternative, right, than just keeping your money in cash, marketable securities, whatever. It is an option. I'm not saying throw all your cash in there. Like I think, an extreme example is Michael Saylor and I wouldn't say Square. I think it's 5% of their cash position is in it that they have in a balance sheet, but 1% cash for some of these companies. I mean, you saw 8,000 plus CEOs sign up for his conference, and that was all about how to do it, how to buy Bitcoin as a corporation, the laws behind it, what you need to do. And a lot of people are interested in it. And this is institutions, guys. Bitcoin has been mostly young people's currency, and people talking about it. This is institutions. This is real. This is real money. This is when tens of billions in a blink of an eye where they forgot they invested in Bitcoin. That's how much money we're talking about when it comes to these guys. It's a joke. It's insane. And that's how crazy it is. And another thing, Dan, I want to talk to you about is...
And real quick, but as investors, sorry, Frank, real quick, there's going to be a lot of different ways to participate and benefit off of this. So we've talked about Coinbase is gearing up to do an initial public offering IPO. I think they were the ones behind the Tesla $1.5 billion buy in Bitcoin. So we'll get to dig into those financials. And that's basically going to be a monopoly once that's starting. There's no other exchanges like that going out. So we'll see how the market reacts on that. You'll have a lot of different companies start doing this. You'll be able to buy funds that have dedicated ETFs and or anything other exposure like that. So as an investor, you haven't missed the boat on Bitcoin. You don't need to buy Bitcoin directly. But it's not a stretch to do so.
Yeah, and that Coinbase, it's going to be a game changer for the entire industry. Just for security tokens, because they're an exchange. In order to build that exchange, is coming out, I believe, at $100 billion plus valuation, which puts them bigger in terms of market cap than I think all the U.S. exchanges combined, which is insane. So, again, a high valuation, but what it's going to bring two things to the forefront, which are two risks that nobody wanted to invest in cryptos, and more regulation. I know if you're Bitcoin, maniac, you hate that decentralization, but you need some regulation. You need to know your money's safe. You need to know that it's protected. And when you go on these outside platforms, you don't know. I've seen people where they just shut down, you lose everything, and you're done. And you can't, there's no number to call on the site. No way. There's no number anywhere. It's crazy. But, the regulation, and it's going to be liquidity where now, you're going to have the IRS in there where they're looking at tax, which you should pay taxes on your capital gains. And you're going to see transparency. And that's going to bring more institutions to it, which is more liquidity. And it's going to be difficult. Those other exchanges are always going to compete, but it's a lot of garbage on those other exchanges where you don't even know these companies. It's like you're just trading like a bunch of bottle caps that are different colors. Seriously, you don't know anything about them. I know. I researched thousands of them. Where Coinbase, you're going to see security tokens. We're getting our financials audited. Hopefully we're attractive to them to be on that exchange, but there's going to be transparency there. Then we need liquidity, which we would have if we trade there. But, that's where this market opens up. And this is where I saw it opening up a little bit sooner, but now I really see it. That's going to happen at Coinbase. I mean, I'm glad you brought that up. It's incredible. Now, I'm going to bring up something to you, Daniel. There's this big fight between gold or Bitcoin. I own both. I'm heavily invested in both, okay? I believe in both. I believe in both because of what's going on with destroying the dollar, just unlimited printing, and I believe in both. But unfortunately, a lot of people out there believe it's either Bitcoin or gold. Now, as we saw Bitcoin rise tremendously, we've seen gold, and I'd say gold stocks, that's how most people invest in Bitcoin or they invest in gold stocks, right? Again, a lot of gold bugs and stuff like that. They have bullion and stuff like that. But gold stocks have underperformed while Bitcoin has surged. Now we saw this week, which was interesting because we saw Bitcoin, crash, right? It's a crash down 20%. Who cares? It's up like, 500% over the past 18 months. It's a crash, 20%. You would think like, hey, maybe money comes out of this and goes into gold, but gold stocks also got hit. So my question to you is, how do gold people convince, right? Those gold investors and analysts, how do they convince the younger crowd to buy Bitcoin when it completely outperforms gold? And even when it falls, it's not like it doesn't even benefit when Bitcoin falls. It's just, it seems like, what's the reason for a young investor to really, I get it for old investors and stuff like that, but what's the reason to get a young investor? I can't see them getting into gold. It's not exciting.
It's going to be tough. Yeah. I mean, because it's going to be the older generation talking and saying, hey, you got to have hard money. You got to have something you can physically hold in your hand. And that's going to be an uphill battle because, like I said, like kids do when mentors and other people try to give you advice, you sit there and you nod your head and yeah, and you're not really listening. It's pathetic. But because in reality, they're going to look down at their phone and they're going to be up X amount of percent. I mean, the thing's up over 100% in a couple months. So like you said, how do you tell them that? The crazy thing to me is that it'll be interesting to see how long the price of gold and silver continue. I mean, silver is actually getting on the Wall Street Reddit bets type deal stuff. So it's performing better than gold. But I don't know why they both can't go up because it's the same argument. You're protecting yourself against silly policies on the federal level and the central banks around the world. And everybody values scarcity. They have both. So, I'm not helping you here much. I don't know why you wouldn't buy both. And once people see the amount of gains that you can get in gold stocks, hell, you talk about 10x. You can make that in gold stocks. So I guess it'll take, it'll take results. So it'll take a nice little, what was it? A couple of years? Was it 2016?
Well,
the first quarter
you had
when gold stocks, I mean, a lot of them went up 100, 200%.
Like that. And then they came back down in, I think, 2018, 19, they really surged. And I was fortunate to know the right people in the industry. I have lots of friends. I speak at a lot of these conferences in Vancouver, which is the mining capital of the world and resource capital of the world. But they've gotten me into deals where I have 5-year warrants to kind of like, you see the stock not doing too well and you're like, whatever. And next thing you know, it's, year 3.5, fourth year. And I'm like, whoa, these things start taking off and then the warrants are in the money. And that's the way, they structure these things. So that's why I own both of them. And it's funny because when I argue this, people are like, Frank, Bitcoin, you're an idiot. I'm the person that believes in both of them. I'm just trying to start that conversation with how do you get gold to be more exciting? Because right now should be a time when people pouring into gold and they're not. Instead, they're purchasing Bitcoin for the same reasons because of what the federal government is doing here instead of gold, which, is not really good for those stocks. Now, let's talk about more, right? What the Federal Reserve is doing, because in this segment, I think is going to be fun because, Daniel always has strong opinions on it about what the Fed's doing and helping poor people and all this stuff. But you had a nice rant and I said, we need to talk about this on a podcast. So I'll let you start with it because this is going to be really cool.
Yeah. So Jerome Powell, Fed chair, is, and let me say, so why do I care about politics and why do I always talk about it? Because you have to pay attention of what's going on and I thought it was a great point Genia made. When volatility hits, you want to be prepared beforehand because if you want to try to buy insurance or whatever during volatility, it's going to be very difficult. The odds are against you. So you always want to have that in the back of your head of trying to, hey, be forward thinking, be productive, be protective. With the Federal Reserve, let's say like Yellen was talking about, I'm switching gears from Fed chair to Treasury real quick here, but just as an example, let's say that she talks about a wealth tax or a transaction tax or higher capital gains tax. if you don't know that that's floating out there and the market is selling off, it clouds your decision-making process. So you want to know what's going on, and if the market's selling off, that's probably an opportunity. Because unless something fundamentally changes, like they start using common sense and start helping people instead of keeping their foot on them, then you got to play in the environment you're in. So I say all that to say this. Switching back, Fed Chair Powell was brought up in front of some committee or whatever, and everybody took the grandstanding chance to talk about helping poor people and the wealth gap and the wealth inequality. And the irony here is that they kept talking about unemployment, Frank. Do you know what unemployment rate is right now? It's like 10%-ish.
I think it's lower than that, but yeah.
And everybody likes to say how we're 10 million jobs less before pre-corona and all that. Why is unemployment so high, Frank? That's a layup question. This is an Abbott and Costello routine. I'll give you a real easy question. Why is unemployment so high?
Basically, we have everything closed. A lot of businesses
exactly
across the board, right?
So
So of course it's going to be high. Yes.
All these members of the committee are up there grilling the Fed chair on doing more, and he had to walk a tight line, and he did well. I can't comment on policy, and I can't. Yeah, it's for you guys, and what we're doing is this over here, and we can't stimulate it any more than what we're doing. They kept talking about the high unemployment, and nobody brought up the fact that it's the reaction to the COVID. The reason unemployment is so damn high is because you shut down businesses for so long. It's a complete waste of time to talk about anything else. Reopen the economy, get the unemployment rate down, get people to actually work again and start making money. That's the best thing. I know they're going to keep interest rates forever, which literally keeps poor people poor on purpose. We can vent about that anytime you want to, but tell me how keeping interest rates low, where you can't earn any money on your capital, and trying to force prices higher every year helps the poorest people in America.
No, it doesn't. But I think you're under the impression that, and this is where it was funny because you were trashing the Fed governors and stuff like that. But the Fed's job, they can't come out and say it, but their job is to make sure that they're inflating the economy, inflating assets, because everything else is going to do pretty good. And they don't come out and say, well, what we're doing here is going to be great for just the low income families. Absolutely not. I mean, that's not. They have to say it.
But I would argue. I think that they do. They sell it that way, and that's what aggravates me so much. They sell it like they're helping the poorest people, and they're trying to get back on their feet. Is it the Fed that's selling it, or is it the politicians? I think
I know when
do.
You said the Fed, you were like pissed off because it's the easiest layup in the world, right? Everyone hates whoever's the head of the Fed. It's so like everyone.
It is easy to
everybody. Yellen, Powell, go back. Greenspan, whoever. It's the layup, right? It's like everybody. For me, when I look, even Ben Bernanke, what they have done during these two periods has been incredible, and I think we have to look at it that way. And I'm not taking this side because I'm going to be literally on an island all by myself pretty soon, right? Just go because nobody's going to agree with this. But if Bernanke if they didn't capitalize the banks, if they didn't stabilize the system, the whole world would have collapsed. We would still be feeling those effects if the Fed did nothing. If nobody did nothing, we'd still feel the effects of 20-25% unemployment rate. And even the pandemic, again, Dan, this is about, hey, we're closing everything. Everyone said they're following the science. They didn't follow the science at all. They're still not following the science. I have no idea why New York, California, they're just starting to open up a little bit, which is insane. In schools, why are they not open? We have all the data. We know who we have to protect. Vaccines, they're saying by May, now the new stats are out that 95% of U.S. adults, by the end of May, that's not too long, are going to have at least one dose of the vaccine. You need to open up. We know who we need to protect. Those people need to protect, but we also know that you have a 99.5% survival rate, and to close everything and force people to close, and not just force people to close, but force certain businesses to close and say, hey, your mom and pop hardware store, you have to close, but Walmart, you're good. You can stay open, which is insane when you think about it. But for me, when I look at what they're doing, is it crazy the amount of the trillions that they're spending? They had to do something. But if they're not there to do something like this, and again, there's going to be huge consequences for it, you have to realize what will happen. I mean, think about, you just closed every business, Daniel, okay? I'm going to ask you this. So that you closed every business, and a lot of these business, or I'd say at least 35% of these, a lot of these are closed, and I'd say even 60-70% are open at a certain capacity. But think about if they didn't give people checks or money or do anything, where would we be right now? You really, the stock market, 100%. You could look at the liquidity injected in the market and look at the trend of stock. It's 100% because of liquidity. It's not because companies manage. There's going to be a couple beneficiaries here and there of the stay-at-home trend. But people get destroyed. I mean, the unemployment rate would be 25-30% right now if they did nothing. And again, what they're doing does not help poor people. But, what do you think, Dan? Because when I look at this, if we didn't have it, I think we'd be in a lot more trouble. But again, you're talking about like the perspective about it and how they pitch it and how the politicians pitch it, which nobody really cares, right? Nobody cares about the poor people, right? Nobody does. And I don't mean us. I mean that the politicians and stuff like nobody really cares, right?
Yeah, absolutely. And I get what you're saying on, I just wish they would do a lot less across the board. So you can't rewind time. So you can't say, well, you shouldn't have shut the economy. I mean, you can say it, but you can't go back and change that. So when you shut the economy down, when you make that decision, I'm not a big government guy, but you damn near have to pay people because you literally force them not to go to work. So I understand the payment there. Now we're blowing that, but that, like everything else, is abused because it's just used to expand the powers and the government reach. And that's not good over the long term on anything. So yeah, you have to pay people now, but you need to reopen and stop it. You just can't continue bad behavior after bad behavior. At some point, you have to stop. And that stopping point, or at least the easing of the gas pedal, is higher interest rates. And that's going to make them nervous. And they'll just come out and reassure, hey, we got free money for longer. They're going to do the yield control capping or yield control curve and all that kind of stuff we talked about.
Done it before, yeah.
But, that's what you got to pay attention to. And the other thing you have to pay attention to is the reaction on that. So if the 10-year goes to 1.5, why is that significant? That's significant because 1.5% is about the dividend S&P 500 yield right now, the S&P 500 dividend yield. So people were thinking, all right, if you got a 10-year treasury paying you the same thing, you can sell assets out of the stock market and get the same yield. That makes sense. But if you're thinking about higher rates for the right reasons, the whole why is important. And they'll come out and say, hey, we're going to cap this. They'll cap the long end. They'll do whatever they have to put the market at ease. The reaction on what the market does after that will be very telling. And that's how we'll position going forward. So it's a little bit of a wait and see. But yeah, it's just going to continue and it's got to stop at some point. And I think yields will help that.
Yeah, I definitely agree. And that is certainly a risk, right? As yields go higher, I think there has been, not think, but you see the money flows of going into equities. But now look where equities are trading. If it's super expensive, and now you're saying if yields go higher, that alternative is kind of like, maybe say, put on a scale of 1 to 100 and all these people are coming into the stock market. Now it's going to be dialed back a lot, so that's a risk to the market as well. But, getting back to the point with the Fed governors, I mean, it's very easy to crush these guys. I like what Bernanke did. I think what Powell's doing right now and the whole trillions and trillions and trillions, guys. I mean, the people who actually got money, the people who actually got money, it's insane because not everybody needed those checks and they went out to everybody. There's businesses that were open. You had places like Harvard and Shake Shack, whatever they were, just filing for the, the loans. And, it's just crazy that, you should be able to find out, okay, these are the businesses that are closed. Here's the families that need them. But to give it to everybody is kind of crazy. And now, there's still, I'd rather give much more to the people that need it because I have friends that own gyms, restaurants, and restaurants are doing good in Florida, but the gyms are still closed, man. And one friend who's a very good friend who's struggling, and it's tough. He was perfectly fine. It was great until they said, hey, you have to close this. And again, with no proof that if you go to a gym, zero proof, believe me, I've covered COVID in more detail than lots of people, lots of doctors, everybody. I've been covering since January telling you about it. There's no proof showing that if you go to a gym that it's easier to get it through a gym than if you go to a Home Depot. There's no evidence of that at all. And they're forced to close, and it's really sad. So it is interesting, and point well taken. But, just to end this is our politicians don't really care about anybody, right? They don't care about anything. They care about getting elected. We have to know that. I mean, they impeached. The House came out and impeachment against Trump in days, yet they how long did it take? 5 months to get the second part of the stimulus out, or phase 2, or whatever phase it is now, I lose count. But come on, I mean, this is crazy. You knew that he was no way going to get impeached, right? You knew it based on the votes, right? Because you need a certain amount of votes. It's not just 50-50, and you knew it for a fact, but you went through that whole freaking process while people are struggling. Let this be about the people and enough about politics because, it's getting a little ridiculous now, and let's see how it plays out. But yeah, no, I definitely agree, Dan. So
yeah, and next week we'll go through some of the bill and maybe have some fun. We'll see what the audience thinks about this, but talking about helping people, and then I'll give my opinion and I'll tell you how to fix everything next week. How about that?
All right, Dan's got it. I'm gonna hold him to that. Fix everything next week. But the bottom line here, guys, is you can get pissed off at the system. You can hold a sign up. You can, again, whatever you want to do. The bottom line is you need to own assets. You need to own assets in this market. So find a way to own assets and you're going to do well. And you want to own the right assets. I'm not telling you to buy Tesla all the way up here or some of these crazy electric stocks vehicle stocks that are up like 9,000% and crazy SPACs. But you want to own assets, and whether that's equities, whether that's housing, whether it's art, collectibles, whatever it is, low interest rates, you're going to continue to see money flow into assets, and that's where you want to be. That's how you play the system, which is all that matters, right? Feeding your family, making money, building a better future for your kids and their kids. If that's the goal, fine. If it's not the goal, go outside, hold up a sign, see how that does for you. But this is the system. This is it. You can be pissed at it, but you have to play it right. If you play it right, you'll make money, and that's what we're trying to show you. Now, one last thing here, Daniel, because this is going to be a pretty cool lesson. Lowe's came out today and reported same-store sales, right? U.S. comparable sales were up 28.6% year over year. I mean, it follows 30%, 32%, and Home Depot was in the 20s. This is a massive, massive number, right?
Yeah.
I mean, we're looking at it, and I saw it, and I said, did you see that number? You're like, holy cow, right? I mean, but you can look at Lowe's and say, I don't know where it's trading. It might be trading down. I have no idea today because a lot of these stocks have run up. But when I look at this, and when Daniel and I look at this, it's 75% of Lowe's sales are generated from do-it-yourself projects. So when I see something like this, I want to go to the conference call. I'm going to read research reports, and some of those I have access to and pay a lot of money for, but you can go to the transcript and read the call. Your job as an investor is to find out what segments inside Lowe's are doing great. Is it lumber, plumbing, water heaters, washing machines, appliances, lighting, faucets, gardening, furniture? Because every segment that I mentioned there, I can name 50 stocks that will benefit. And their sales are so good, those inventory levels are low, that you're going to see those profits show up. If it wasn't this past, you're going to see it show up next quarter after, and you could jump the gun on a lot of these by listening to the conference calls. And I've always tried to train people to do this, but when you see Lowe's, I mean, those numbers are incredible.
Yeah, absolutely. And to answer your question, everything is up. I mean, lumber, grills, lawn and garden. They just have a nice little 2-page kind of press release. And listen to this, positive comparable sales exceeded 16% in each department across decor,
Wow.
electrical, building materials, paint, lawn garden, lumber, and seasonal and outdoor living. And the other thing that jumped out to me was purchases over $500 rose 29%. So you're getting bigger ticket items. And I know a ton of people that are doing home projects and stuff.
Yep.
And, there's some nice communities here on the island, and I know a couple people, and hell, they go to Lowe's and Home Depot every other day. So that's going to continue. That trend is going to be with us for a while. And I apologize to Dollar Stock Club members because we sold Toll Brothers at a very small gain, and it's done nothing but go straight freaking up since. So if you ignored that email, congrats to you. And hell, I would jump back in at current prices around 50 to tell you the truth.
Yeah,
so.
Toll Brothers came out. But say that again, because that was interesting. Because when I first saw this, and guys, just to let you know what the schedule, I'm writing this thing up, we're doing the podcast, and I said, do me a favor, got a lot of topics to talk about today. Try to find out the details of Lowe's, and you did that. You did a great job. It was a 2-pager.
Well, they make it easy. So
yeah,
thank
well,
you.
it wasn't that easy because I tried to look at it really quickly, and I didn't see it broken down yet. But it was about 3 hours ago. So before we taping this, but what'd you say about the 16% number again? What is that? Every category?
Yeah, each of those categories from lumber to decor, positive comps exceeded 16% in all merchandising departments.
That's insane.
So everybody's buying everything. Projects are full speed ahead on that. And like I said, people are spending money, and now you got another round of stimulus coming. There'll be talks of a third one coming, plus an infrastructure. That's also, again, why you need to pay attention to politics. So, buckle up.
And it just goes to show you, for those that are bearish in this market, when every single segment, people are fixing their houses. Wait till you see the explosion in travel industry. Holy cow, that's coming. MGM just announced they're opening up fully their casinos in Las Vegas. You're going to see this, across the board, where it's going to be hard to get a flight. It's going to be difficult to get a hotel room. Everyone's dying to go out. They have money. They didn't go on vacation last year, so they're probably going to spend double this year and fly first class, whatever. But there's still a lot of room, and it's a reason why in this market. And Daniel can attest to this, where you would think that the S&P is crashing. It's down like less than 2% from its all-time highs.
Yeah.
And you would think that. Why? Because what are the companies they cover? Technology, Teslas, Apples, Netflix. Companies are getting nailed. that's what people click on, and that's what the media is going to show you. But overall, there is something that's working very, very good, and it's done very well in this week when the market didn't do so well, and that's cyclicals, right? And we were in a very early with these stocks in our portfolios. I just recommended another one. They have tremendous upside potential. These guys are just hitting or going near their highs pre-COVID, but remember, they cut costs significantly. So they could generate the same revenue, and yet their profits are going to explode by 20, 25% more. And it's not factored in because the demand that they're going to see is incredible. And it's a lot of names. I'd be looking at infrastructure. I'd be looking at travel-related companies. You've seen those show up in my portfolios. But damn, this is for real. It's going to happen for a while. And again, you want to protect yourself, like I said earlier, in certain. But I mean, right now, not that it's pedal to the metal, but still, the things that are working and just the underlying trends are going to make sure that you're going to always have some sectors to invest in that are going to do well.
Yeah, absolutely. There's always going to be what's your guys say? Always a bull market somewhere. That's a good saying.
Yeah, my guy, Jim Craven.
There's
always a bull market somewhere.
Yeah, yeah, absolutely. I mean, there's always going to be pockets there, and that's good. And just, I know this sounds easy, but in my opinion, this is the best advice I can give anybody right now. There's a huge disconnect between reality and the economy and the stock market, but who gives a shit? We're in the stock market, so let's go.
Yeah, I miss Kramer those days. I was really when the show first started, when it began.
Yeah,
and just when he was thinking about what sayings for the buttons and "Are you ready, Ski Daddy?" all that stuff and everything. We have like bulls sign, like the little bulls, the red.
I will say, I know we're a
bulls.
little long here, so we need to wrap this up. But I do want something for my birthday. I want a soundboard in here. I want to be hitting buttons like crazy. So we need to work on that, Frank.
Soundboards would be cool, especially if we had like movie quotes in it and stuff like that. That'd be awesome.
We'll pull one up on Google. Maybe we'll do that.
If anyone knows anything about soundboards, let us know, because that'd be really, really cool. We'll definitely do that. That would be fun.
Send us one.
But you're going to be hitting that thing all the time, man. It's going to be crazy.
It'd be great.
Anyway, Daniel, thank you so much for coming on. Really appreciate it as always. And Daniel, join us next week. But really great stuff. And again, we like talking about the current topics and what's going on. This is based on the emails I get from you. So feel free to email frank@curzioresearch.com. I'm always here for you. And two things. Be sure to check out our Curzio Research YouTube page where we show charts and everything. Again, all this is in video. It's really cool. We're getting very, very positive feedback. Subscribe to it, like it, whatever, hate it, whatever you want. But it just gives you an alternative, and it also shows the sites and things and some of the research that we use, which is cool. Gives you a better experience. But iTunes is awesome as well. But if you get a chance, if you want to look at that, you can, and that's absolutely for free. And the last thing is Moneyflow Trader. We talked a lot about hedging. We had Genia on. You see how smart she is. I love her. Again, a great addition to the team. For the next 10 days, I'll discount that newsletter for you guys because I think it's a very, very good time. There's sectors and stocks. Yes, Daniel and I just talked about things that are working and lows and all this stuff, but there's also things you're going to see rotations and taking advantage of that, or taking advantage if interest rates go higher and the overall market comes down. That's how you hedge. It's very simple to do. You can do it to your portfolio. So I'm going to offer a 50% discount if you're interested over the next 10 days. If not, no worries on that product, but it's something that I think is going to help you tremendously. It's a product that once you subscribe, I really truly believe that you'll be subscribed for many, many, many years because that's how good it is. So guys, that's it for me. Thank you so much for listening. Views going up. Everything's really cool. Keep the comments coming. Positive, negative, whatever. If you want to yell at me, get that off your chest. It's fine. I'm here for you. Doesn't matter. But really, I appreciate it. Pretty humbling sometimes when I think about how many people listen to this, but it's really, really cool. I just want to say thank you. And I'll see you guys in 7 days. Take care.